Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on a Monday, September 11th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, we're diving into FTX's legal labyrinth involving a staggering $86 million. Then we're shifting gears to India, Coinbase's hasty emails, government policy, and the central bank's digital aspirations. We've also got a Bitcoin user who made a $500,000 mistake, a Hong Kong-based project revolutionizing decentralized identities, and a social media platform that's proving the naysayers wrong. Buckle up. Failed cryptocurrency exchange FTX is embroiled in legal battles on multiple fronts. The company filed a lawsuit against LayerZero Labs to recover $86 million transferred just before declaring bankruptcy. LayerZero Labs accused FTX of making unsubstantiated claims in the lawsuit. FTX's bankruptcy filings have also revealed substantial payments to celebrities. The list includes nearly $750,000 to Shaquille O'Neal, about $308,000 to Naomi Osaka, almost $206,000 to Trevor Lawrence, and about $271,000 to David Ortiz. These celebrities are now subject to lawsuits by FTX creditors. LayerZero allegedly exploited FTX's sister company, Alameda Research, by demanding immediate repayment of a $45 million loan. In exchange, Alameda transferred its entire 4.92% equity stake in LayerZero. The deal was considered highly favorable for LayerZero. FTX also seeks to cancel prior agreements and recover $21.37 million that LayerZero allegedly withdrew illegally. The company is exploring options to claw back funds paid to celebrities and sports teams to settle its debts. Now, from my point of view, FTX's legal entanglements are a glaring example of the risks and volatility in the crypto space. The company's aggressive marketing strategy, involving high-profile celebrities, backfired spectacularly. It's a warning for investors and a point of concern for regulators. LayerZero's alleged exploitation of Alameda Research's financial distress raises ethical questions. It also highlights the lack of oversight and the need for stringent regulations in the crypto industry. FTX's attempt to recover assets and cancel prior agreements could set a precedent for how companies in financial distress handle their obligations. It's a complex web of legal and financial maneuvers that could have far-reaching consequences. The unfolding drama reminds us of the dangers in rapid expansion without adequate risk management. It's a lesson for other crypto companies and a wake-up call for the industry at large. Lawsuits and bankruptcy are one thing, but what happens when a crypto exchange throws a curveball to a whole country? Before we unravel this, don't forget to hit that subscribe button to stay updated. Coinbase recently sent emails to some of its Indian users, stating it would discontinue services for them after September 25th. The email urged users to withdraw their funds from the platform. The email was not sent to all Indian users, but only to those who were found to be in violation of Coinbase's updated standards. This led to confusion and panic among Indian traders, who took to social media to express their concerns. Coinbase clarified that the email was part of a routine review and was sent to users who no longer met their updated standards. The exchange also stated that this move does not affect users' access to Coinbase cloud services. Coinbase entered the Indian market last year, but faced several challenges, including regulatory issues and the suspension of UPI support on the platform. The company also stopped onboarding new users from India earlier this year. Coinbase's actions come at a time when India is hosting the G20 summit, where global cryptocurrency regulation is being discussed. The Indian government is also evaluating recommendations for regulating crypto assets. Despite these developments, Coinbase remains committed to the Indian market and continues to offer its wallet services. The timing of this event and the ongoing G20 summit in India cannot be ignored. Is Coinbase feeling the heat from global regulatory discussions? Or is this a strategic move to tighten its user base and comply with evolving regulations? Either way, the incident has sown seeds of distrust. Coinbase's selective email to certain Indian users also raises questions about transparency. What are these updated standards, and why were only specific users targeted? It's a murky situation. Moreover, the Indian government's stance on cryptocurrency is still unclear, adding another layer of complexity to Coinbase's operations in the country. With the G20 summit discussing global crypto regulations, Coinbase's actions might be a preemptive measure to avoid future complications. While Coinbase remains operational in India, the incident calls out the vulnerabilities and uncertainties that come with centralized systems. Coinbase's recent actions in India have clearly caused a stir, highlighting the tensions between centralized crypto platforms and regulatory ambiguity. But as we pivot from this snapshot of crypto's current standing in India, let's widen the lens. Now, we were just talking about the G20. It's not just the exchanges that are at a crossroads here. The Indian government itself is on the brink of setting the course for crypto's future. And their decisions won't just affect the subcontinent, they're positioned to influence the global crypto landscape via their presidency of the G20. So from the individual worries of Coinbase users to the collective anxiety of the global crypto community, we see that the issues are deeply interconnected. Both are waiting for India's next move, which could either enhance financial freedom or tighten the government's grip. So here's what's going on, more broadly speaking. India's finance ministry is set to decide its stance on crypto in the coming months. The country has been under scrutiny for its harsh crypto regulations, including taxes and anti-money laundering rules. However, there is a shift towards possibly framing its own legislation, a first since early 2022. India is also working on a 5-point crypto legislative framework. This includes advanced KYC for crypto companies, real-time proof of reserve audits, a uniform taxation policy, and possible authorized dealer status for crypto platforms under the Reserve Bank of India's guidelines. The government aims for global collaboration on crypto taxation and anti-money laundering standards. The RBI revealed that its central bank digital currency has around 1.5 million users. What's more, there are over 300,000 merchants accepting digital rupees. The pilot is operational through 13 banks in 26 cities. The RBI aims for 1 million daily CBDC transactions by December. The Indian government's upcoming decision on crypto regulation is a pivotal moment, not just for the country, but for the global crypto landscape. India's influence at the G20 summit indicates its significant role in shaping international crypto policies. While the government has been historically stringent, the shift towards possibly framing its own legislation is a positive sign for the crypto community. The 5-point legislative framework is particularly noteworthy. It shows a nuanced approach to regulation, balancing the need for oversight with the potential for innovation. The focus on global collaboration is a smart move, given the borderless nature of crypto. However, the RBI's push for its CBDC raises concerns. With 1.5 million users and 300,000 merchants, it's clear the government is pushing for a digital rupee. This could be a strategy to divert attention away from decentralized cryptocurrencies. The RBI's ambitious goals for CBDC transactions could be a double-edged sword. On the one hand, it could provide valuable data for crypto regulation. On the other, it could be a step towards sidelining decentralized cryptocurrencies in favor of a government-controlled digital currency. From India's regulatory maze to one Bitcoin user's jaw-dropping mistake, if you thought gas fees were high, brace yourselves. And hey, ring that notification bell so you don't miss out on stories like this. A Bitcoin user recently paid an eye-watering $500,000 in transaction fees to move a mere $200 worth of Bitcoin. The transaction was made on September 10th at 5:10 p.m. UTC. The wallet involved in this transaction is no amateur. It's been part of over 120,000 transactions. The transaction fee went to the Bitcoin mining pool F2 Pool. Chung Wang, the co-founder of F2 Pool, stated that the 20 Bitcoin fee would be held for 3 days to allow the originator to claim it. If unclaimed, it will be distributed to the pool's miners. This incident has set a new record for the most expensive transaction fee paid in US dollars for a single Bitcoin transaction. The average cost for a Bitcoin transaction is around $2.17.6, a significant decline since July. However, fees can fluctuate due to network congestion. For instance, during the 2017 cryptocurrency surge, fees spiked to nearly $60. This incident has sparked renewed discussions about Bitcoin's network scalability and effectiveness. Despite these mishaps, Bitcoin remains prominent. Recent data revealed that a total of 717,331 new Bitcoin addresses were generated over the weekend, marking the highest number in the past 5 years. Now, this isn't just a story of a costly mistake. It's a glaring spotlight on the vulnerabilities and inefficiencies in the Bitcoin network. Now think about it. A transaction fee that's more than double the GDP per capita of some countries? That's not just an error. That's a system begging for scrutiny. The mining pool F2Pool is essentially holding $500,000 hostage for 3 days. Now, sure, they say it's to give their user a chance to claim it back, but what if they don't? That's a windfall for the miners and a hard lesson for the user. But should such a lesson even exist in a system that's supposed to revolutionize finance? This incident also serves as ammunition for critics of Bitcoin. It shows that despite its promise of decentralization and low fees, the network is far from perfect. And let's not forget, this isn't the first time high transaction fees have made the headlines. It's a recurring issue that raises questions about the scalability of the network. Now, shifting from Bitcoin blunders to the future of gaming and digital identity, want to be part of the future? Then hit that like button and let's dive in. Animoca Brands is a company based out of Hong Kong. They raised $20 million in a funding round led by CMCC Global. The funds are earmarked for Mocaverse, a project that aims to provide Web3 native tools for gaming and entertainment. Other participants in the funding round include Kingsway Capital, Liberty City Ventures, and GameFi Ventures. Individual investors like Alexander Larson and Gabby Dizon also took part. The company issued simple agreements for future equity, or SAFEs, priced at about $2.90 each. These SAFEs will automatically convert to ordinary shares in 6 months. Animoca also offered a free attaching utility token warrant on a $1-to-$1 basis to the participants. Mocaverse aims to serve as the digital identity, reputation, and loyalty system for decentralized organizations. It plans to launch Mocha ID, a non-transferable NFT collection designed to enable users to craft their on-chain identities. Mocaverse started last year and already has an NFT collection called Mochas, offered in 5 different classifications known as tribes. These tribes represent different personalities in the Web3 industry. The Mocaverse ecosystem has a network of over 700 million potential users. Holders of Mocaverse NFTs get access to educational classes, can test game activities, and have exclusive access to in-game asset drops. Now, to be clear, Animoca Brands isn't just another player in the Web3 space. They're shaping the future of decentralized gaming and entertainment. The involvement of CMCC Global, a venture capital firm solely focused on blockchain technology, signals a significant endorsement of Animoca's vision. The issuance of SAFEs is a strategic move. It not only secures immediate funding, but also ensures a future equity stake for investors. This is a win-win for both Animoca and its investors, aligning long-term interests. The project's DAO-based approach ensures that its community will be focused on driving innovation, not just following orders from a centralized authority. Mocha ID is another game changer. It's not just an NFT, it's an identity. In a world where data privacy is a growing concern, owning your digital identity is a step towards true freedom. So we've seen pitfalls and potentials. Now let's talk about a phoenix rising from the ashes. And this is our cover story for tonight. Friendtech, a decentralized social platform, has been making headlines for its remarkable comeback. The platform's total value locked has surged past $20 million in just 4 days. This comes after critics had declared the platform dead due to dwindling activity. On September 9th, the platform recorded a daily trading volume of $12.3 million, surpassing even OpenSea's trading volume by more than $3 million. The platform also generated significant revenue, hitting $5.6 million on September 9th. Friendtech has been facing issues with sniper bots, which artificially inflate the prices of popular creators before their shares hit the market. Despite these challenges, the platform has implemented several updates to enhance user experience, including photo uploads and credit card-enabled purchasing options. The resurgence in Friendtech's activity might just be a testament to the platform's adaptability and the growing interest in decentralized social media. While critics were quick to write off Friendtech, the platform's team has been agile in addressing issues and implementing updates. This not only has regained user trust, but also attracted a broader audience, including non-crypto personalities. The platform's revenue and TVL are not just numbers. They're indicators of a thriving ecosystem that has the potential to disrupt traditional social media platforms. However, it's not just all sunshine and rainbows. The platform's sniperbot issue is a significant concern that could undermine its credibility. Moreover, the intense flipping activity, which has been a major driver behind the platform's recent surge, is something of a mixed bag. It brought a lot of activity, sure, but it holds the potential to create a volatile and unpredictable environment. So while Friend.tech's comeback is impressive, it's crucial for the platform to address these challenges to sustain its growth and to live up to its promise of revolutionizing social media. So what happened? FTX is caught in a legal quagmire, suing LayerZero Labs for $86 million and facing accusations of its own. Celebrities are being roped into the mess as FTX tries to settle its debts. Coinbase stirs chaos in India by sending selective emails to users. This incident is causing ripples at a time when India is in the global spotlight for crypto regulations. India's finance ministry is at a crossroads, leaning towards framing its own crypto legislation. Meanwhile, the Reserve Bank's central bank digital currency is gaining traction, raising eyebrows among crypto advocates. A Bitcoin user coughed up a staggering $500,000 in transaction fees for moving just $200 worth of Bitcoin, a cautionary tale that puts Bitcoin's scalability into question. Animoca Brands raises $20 million for Mocaverse, a project aimed at empowering users in the Web3 world. The investment marks a step closer to a decentralized digital identity. Friend.tech defies critics with its comeback, surging past $20 million in total value locked in just 4 days. Yet issues like sniper bots still pose a threat to its credibility. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.